Welcome to your Mortgage Insider Update for this week. We are kicking off July with the unemployment rate going to 4.1% in June. The 3-month average of the unemployment rate has ticked up now for an average of 4%, which is 0.5% higher than the lowest level of unemployment at 3.5% in the prior 12 months. What does that mean? It means the SAM rule is in place. That's SAHM. This is a phenomenon that has been basically the predictor of the last 80 years worth of recessions, where the unemployment rate after the low point in unemployment goes up on the 3-month average, which is now increased for the third month in a row to increase 0.5% above the lowest level. That has predicted a recession in literally the last 80 years. It's been wrong one time. So we're going to take a look at the charts and see what this means to the future of interest rates. As we look over the SAM rule recession indicator, the red line indicates a 0.5% increase on the 3-month average of the unemployment rate over time as it hits the bottom. So we can see levels where unemployment was at its lowest. And then as it ticked up to 0.5% above, and some levels it went way above the lowest level of unemployment if we weren't already in a recession, which oftentimes isn't recognized until well after the fact. You can see that the red line is crossed every time except for right there it peaked and then actually came back up into that level. But again, 0.5%. So very good indicator that long term there could be a recession, and this is dating all the way back in this chart going back to 2010. So leaving out the COVID recession, this is a pretty good indicator that unemployment is starting to head in the wrong direction, and the Fed might have to act sooner rather than later. As we take a look at the 10-year Treasury, I want to go back a whole year in time. You can see the 10-year Treasury has been higher than it is right now. That was our not very much fun time back in October of 2023, but we've been awfully low back in December, down to 3.8%. And this year, the 200-day average, this blue line here, is going to just show you the trend that we have been on an upward cycle, and there's been lots of ups and downs along the way. But just recently here, we've taken back to the 200-day moving average, and this last week we have been able to move back below that average after a short stint, which we'll take a look shorter. After this short stint for a few days, we're really surprising the market reacted the way it did as conditions came out prior to the jobs report, really pressuring interest rates higher in the short term, only to be pulled back down into a good range for this week starting out. We'll get some big news this week with Jerome Powell. Powell will be giving his remarks to both the Senate and the House this week in his semi-annual report, where he'll be grilled on his actions at the Fed and the direction they're moving. So I'm sure the markets will be listening out for his words on Tuesday and Wednesday during his testimony, but we'll also have the CPI report coming out following that on Thursday, which, pretty sure inflation has calmed and we have continued to get better and better reports. We're not expecting huge drops in inflation, but 0.1% to 0.2% drop in the headline inflation would be positive for the markets, assuming that the Fed chairman hasn't dropped any bombs on his testimony. But we'll see. I'm sure unemployment will be a big part of what's brought up. Maybe even the SAM report, the SAHM, Bureau of Labor Statistics report that we just went over, could be part of the fireworks at the Congress this week. So stay tuned. We'll come back with you next week with updates. There will be 10-year Treasury auctions. There'll be a PPI report on Producer Price Index on Friday. So action-packed. We'll take a look at next week for a lot of great information. Have a great day.